Today's topic, a call debit spread, also known as a bulk credit spread. We will start by explaining how it works, and then we will go through three live examples that I have in my account. The first is on Netflix, the second is on PLTR or Palantir, and the third one is Amazon. After that, we can go and see if we want to open a new one on Tesla, how it works, how it will cost us, and discuss the different scenarios. For the example on Amazon, we will discuss it in a little bit deeper and we will go through my spreadsheet and compare it to buying the stock or buying just a call versus the call debit spread, and it will become clear where its advantages versus its disadvantages. Let's dive in. A call debit spread is when you are buying a call option at a lower price and then simultaneously selling a call option at a higher price within the same expiration date. The maximum profit in this strategy is achieved when the stock price reach or exceed the call strike that you have. The maximum profit is the difference between the call that you bought and the call that you sold, minus the debit or the cost that you paid to open this option. The risk is limited to the amount of debit that you paid. So if the stock crashes or even went bankrupt to zero, you will not lose more than what you put to open this call debit spread. Let's go ahead and start by reviewing our Netflix example and everything will fall into place. As you can see, Netflix is right now at 679. But if we went to my option, I have a call debit spread on Netflix where I'm buying for 400 and I'm selling for 500. So the difference between the two is $100 per share multiplied by 100 share resulting in 10,000. If we scroll down here, you will see that I have opened this call debit spread on July 19, 2023. I have paid to open this contract $5,162. The expiration date is for June of next year. So that's June 17, 2025. So this is a call debit spread using leaps. I have paid $51.62 per share for the chance to win or to profit for $100 per share. So I'm almost making double my money, like a little bit less. Let's consider double my money. So right now, because the share of Netflix have went up significantly during the last year, as you can see here, it's at 679, meaning my call debit spread is deep in the money. So you can see here my unrealized profit is plus 73% or $3,783 if I were to close it today. To achieve the maximum profit of $100 instead of $89.45, I will have to wait until the expiration date. And at that time, if Netflix price was above 500, both options will exercise, meaning the first option will exercise for me to buy for 400, and then immediately the second option will exercise to sell for 500. So I will get debited $40,000 to my account, and then I will get credited $50,000. The difference between the two is, of course, the 10,000, which is my maximum return. If we go to history here, we will see that I have opened this on July 19, 2023, and it was at 7:35 a.m. You can see here the details for the buying call, which cost me $15,158, which was a big amount. I didn't want to risk that entire amount, so I went and I sold against it the sell for Netflix for 500 for 99.96 or almost like 10,000. So in this case, the total debit that I paid was 5,162. So let's check quickly what was the price on July 19 for Netflix. If we went to the 1 year here and check July 19, approximately the price was at $477. And that's why it cost me a little bit more than half to open this contract. If I were to open it out of the money, definitely I will pay much less, but I am taking bigger risk. In this case, this call debit spread played out nicely. Let's go ahead quickly and jump to the next one. The next one on the list is PLTR. Let me show you my call debit spread here. I am buying for $12 and I'm selling for $20. So the difference between the spread is $8 or $800 per contract. Right now, it's priced as $642. If we scroll down, you will see I have opened it on December 18, 2023. My average is 389. So this is a little bit more than double because I'm paying 389 for the chance to win $800. Right now, my unrealized return is 65%, which is $759. If we scroll down, you will see that at the start on December 18, I have opened two contracts, which I paid for them $817. To show you the price of Palantir at that date, I'm going to go ahead and go for Yahoo Finance. If you see here on December 18, this is the range that the stock were. The highest of the day was $18.58 and the lowest was $17.77. PLTR went down, so that's why I went and I opened another one to reduce my cost. So on January 31st at 8:40 a.m., if we go here back to Yahoo Finance, you can see on January 31st, the stock price was between 16.07 and 16.76, which is clearly lower than when it was on December 18. That means the price was dropping, which gave me the chance to open a third call debit with a lower cost for me. Now, the third one is Amazon. So on Amazon, I have a call debit spread. I am buying for $150 and I'm selling for $180. Now, this is the call that we're going to spend most of the time in this video on it. We're going to analyze it and dig deep into it. So as you can see, we have opened it on April 17 and it expired on June 21st. So it's approximately 2 months. I have paid $2,255 to open this contract for a possible of $3,000. So it's not 50%, it's a little bit lower because it was in the money. If I remember correctly, the stock price at that time when I opened it, which was at 10.43, it was about between 182.5 to 183. We're going to go ahead and assume it was 182.5. To fully appreciate the power of call debit spread here, we are going to compare it to using the money in investing in the stock versus just buying a call and taking a bigger risk, but potentially a bigger return. Versus finally the debit spread that I have open here. If we use the $2,255 to buy stocks at that time, since the price was 182.5, if you divided that amount, it's going to result in 12.35 share. If these shares went up to 190, it will result in $7.50 profit during these 2 months, multiplying by the 12 share 0.35, resulting in 93 profit. And the opposite is the same. If the price dropped to 175, then you are going to lose about $93. Now for the call, to keep things simple, I'm just going to use the call that we have in this spreadsheet, the buy for 150, without any sell on it. But that means we are spending more than the 2,255. And to be accurate, we are spending about 150% because this is 50% more than 2,255. In any case, if the stock appreciated to 90, then we are going to buy for 150 and we are going to sell for 190, resulting in $40 per share or $4,000 per contract. Minus the debit we paid here, the $3,427, resulting in profit of $573. Now, if the stock went down to 175, we are going to buy for 150 and sell for 175, resulting in $25 per share or $2,500 per contract, minus the $3,427 we paid, resulting in a loss of minus $927. In the debit spreadsheet, we said we are opening the same call for $3,427, but we are also simultaneously selling the 180 on the same date, which is going to be a credit for us of $1,172, reducing our overall cost to $2,255. So if the stock rallied to 190, since we have a sell at 180, we are still going to sell it at 180. That means we're buying for 150, selling for 180, generating a $30 per share or $3,000 per contract, minus the $2,255 that we paid debit to open this contract, resulting in $745 profit, which is a little bit more than buying a call. But remember, during this buy call, we invested a bigger amount. We invested a bigger amount by 50% compared to the 2,255. And still we resulted in a bigger profit. Last scenario in this case, which is if the stock dropped to 175. In this case, we are buying for 150 and selling for 175, resulting in 2,500 credit, minus the 2,255 debit that we paid before, resulting in 245. So I'm pretty sure you started to see the power of call debit spread. In this case, it result in 245 profit, even that the stock dropped from 182, which was the price when we opened this call debit spread, to 175. We still end up with a profit. However, if you were just to buy a call, you will have end up with a big loss of minus 927. And if you just bought the shares, then you will end up with a smaller loss, but it's a loss nonetheless, which is about $93. Let's go ahead and take an extra two examples for a bigger rally and a bigger drop in the stock. So let's say the stock went up to 200 or the stock went down to 165. Let's see how it's going to affect us. So if the stock rallied to 200, well, it increases our profit per share to 17.5. And since we have a 12 share 0.35, we are going to end up with a profit of 216. The opposite will happen if we drop to 165. We are going to lose $17.50 per share, resulting in a similar loss. Let's go ahead and check the call. In this case, when we go to 200, well, since we have no cap on the buy 150, this is the golden scenario for buying a call. We are going to generate $5,000, which is the difference between the 200 and 150 multiplied by 100, minus the debit that we paid to open this contract, resulting in 1,573 profit. Absolutely great, right? In the case the stock dropped to 165, so that's a drop of $17.5 per share. The buy call will get destroyed because it's only going to generate 1,500 minus the 3,400, resulting in 1,927 loss. Very big loss. We don't want to see that. That's more than half the amount that you invested here. Let's go ahead and take a look at the call debit spread. The profit here are still capped at 180. Meaning we are receiving the same when the stock ended at 190 or 200 or anything above. We are receiving 745, which is the maximum for this trade. Let's check what happened when the price dropped to 165. We are going to have only 1,500 premium left, similar to here. However, since we paid lower debit to open this call debit spread compared to just buying a call, we are going to end up with a lower losses of minus 755. Again, as you can see, these are the three scenarios in case it went up or it went down for comparison between a debit spread, buying a call, and a stock. Now, finally, let's go ahead and see what's the actual result for this trade, since tomorrow is the final day or the expiration day, and I'm already decided to either close it or let it just get assigned at the end of the day. Right now, the price ended on June 20 at 186. Let's go ahead and go back. You see 186.10. Just to keep the math simple, we are going to assume it's 186. In this case, we would have held the 12 shares 0.35 that we bought for 2 months to generate only $3.5. Since we bought the share for 182.5 and right now it's 186, resulting in only $43 profit. Now, in the case of the call, since the 150 is going to be in the money, we are going to buy for 150 and sell at 186, resulting in 3,600 credit minus the debit that we paid, which was 3,427, resulting in $173 profit, which is small comparing to the amount that we invested for 2 months. Now, in the third scenario, since the price is at 186 above the sell for 180, that means we are going to generate the maximum profit for this trade. 3,000 minus the debit that we paid, which was 22.55, resulting in 745. If we took the calculator quickly and divided the 745 by the amount of money that we invested, it will result in 33% profit in 2 months. Divide that on 2, resulting in 16.5 profit per month. That's absolutely great, while we're only limiting our potential losses to only 2,255, just in case something bad happened with Amazon. But I didn't expect that to begin with. Amazon is one of the big companies. It's a very stable company. So as you can see, this is the full picture and comparison between investing 2,255 in the call debit spread versus the stocks. And we even put more money in buying a call, and still most of the time we come up ahead in the debit spread. Since I only have tomorrow, the Friday, June 21st, if the stock dropped from 186 all the way to 180, I still get my maximum profit. So I am not worried at all. But imagine if I have just the call or just the stock, the profit would have been small in the case of the stock. And in the case of the call, I would be worried because if it dropped to 180, then I start losing money actually, not even break even. So finally, let's go ahead and jump and open stocks like Tesla and see how we can open a call debit spread, the different scenarios which potentially different profit or losses. So as you can see today, Tesla is 181.5. It was a down day. If we look at the week quickly, it went down by 2.4%. On the 1 month is green. On the 3 month, year to date, it's been down minus 27%. And the last year, it's minus 30.59. Since I believe in Tesla and its performance for the future, when the stock is down, it's actually just giving me a better opportunity to enter at a better price. So let's go ahead and open trade Tesla options. We are going to go maybe a month ahead in time. And here we can discuss the different scenarios that we can go through. Buying something like 150 and selling the 180, exactly similar to my example on Amazon. It just happened to be a coincidence since they are both similar price. You can see in this scenario, it will result in a total cost of $2,232 to buy the 150 and sell the 180, meaning the difference between them is $30 per share or $3,000 per contract. So this is an example of buying calls is in the money. As you can see, the win are less than half the money because you have a protection since you are buying in the money. Let's go ahead and see if we want to sell instead of the 150, we going to sell the 200. Since we are taking a bigger risk here, we are going to pay a little bit more. However, the potential profit are bigger. If we look at the graph, you can see where we are right now. Where is the break even? Where is point when we reach our maximum profit and the point we reach our maximum losses? You can see under it, the maximum profit is the $2,070. The maximum loss is the $2,930, which is the total cost that you're paying. Let's play with it a little bit more. If we went to something like August 16, let's say you are very bullish on Tesla. So you can, for example, buy the 200 and then sell the 225. Your potential return is $25 minus the $485 that you paid. You can see the chart again. The maximum losses is achieved if the stock failed to rally above $200. Your break even is 204.85, which is the strike price plus the debit that you just paid. And finally, your maximum profit will be at 225. You need the stock to rally about 24% to achieve your maximum profit in just 2 months. Feel free to play ahead with it on different dates and different numbers and see where is the spot that you feel comfortable with. The bigger the risk, the bigger the return. The smaller the risk, the smaller the return, but the possibility of you winning will be higher. I hope you found this video useful. If you have any question about how to do a call debit spread or you have a specific scenario, feel free to drop it in the comment. I will respond to you. If you like this video, please drop a like, subscribe to the channel. If you want to see how to roll over a call or a put, check out my last video for 20 options expiring this Friday.